Hey, everybody. Had lots of questions about how to go about creating a balance sheet and a profit and loss for a business plan, especially in the sense that when we're creating a balance sheet and a profit and loss for a business that hasn't started, we don't have any numbers. And so it's a little confusing how to go about doing that. So I just wanted to kind of go over that today and kind of maybe talk you through the process. So typically, when we create a balance sheet for a pre-financed business or a business that doesn't have anything yet other than what the owners have brought to it, we'll create what's called a pre-financing balance sheet and then a post-financing balance sheet. And a pre-financing balance sheet just includes all of the assets, that's the thing the business owns, the liabilities, any debts the business has, and then the equity or the money put in by the owners uh, before the business starts. So up on the screen, I've got a sample of what one looks like. And in essence, you can see that this company has $27,500 in cash, $20,000 in land, and $5,000 in equipment. And that all of that was financed by the owner's contributions. So they haven't received any funding from a bank or from any other sort of lender, nor have they sold stock to outside parties. This is just the business's financial position before any financing other than the owner's financing. So if I were doing this for my own, business plan that I was doing for the class, the numbers might be different. Maybe it'd be a very small business. Let's just say I was going to start an Etsy shop, and really, all I would have would be, let's say I have $1,500 in cash that I put into the bank. No land, no equipment. I don't know, maybe, I mean, that's all I really have. I haven't borrowed any money for the business. And so all 1,500 of that has come from me, the owner. So that would be my whole pre-financing balance sheet. It would just show that I had 1,500 in cash and 1,500 in owner contributions. Or, maybe I had some supplies. My wife is a paper crafter. She's probably got $500 worth of paper. And so we could put that as a supply, add a line for supply and put that in there. So all the pre-financing balance sheet is the financial position of the business before any additional financing is sought. So once we've created that, the next thing we would do is create a post-financing balance sheet. So this business, you can see that they took a long-term loan of $85,000. And with that $85,000, they bought some additional assets. If you remember what we had on pre-financing, they had 27,500 in cash, 20,000 in land, and 5,000 in equipment. So now you can see they've spent some of that cash, but they've added some inventory, which is the stuff they're going to sell. We have land and buildings and equipment. And so now they have total assets of 137,500, but debt of 85,000. And then the owner's contribution is still 52,500. There's still no retained earnings because the business hasn't done any business yet. So if you're doing some type of a small business where you don't intend to take a loan, say you're going to self-finance, then your post-financing balance sheet, you would just put a note in your business plan saying the business is not seeking any financing and therefore there is no post-financing balance sheet. It would just be the amount that the owners contributed. This would be the same as your pre-financing balance sheet. So that's all we're really doing. A couple tips on a balance sheet. Remember that the total assets has to add up to the total liabilities and total equity. So they have to balance or be equal. And, when you think of it in that terms, it's like saying, what are all the things the business owns, all of its assets? And then how are those things paid for? Some of those things are paid for through debt. Those are the liabilities. And others were paid for through contributions by the owners. And then later in the business, after it's earned money, we can also say some of the stuff was paid for through retained earnings, which means money the business earned, but didn't spend back out by giving it back out to the owners. Anyway, so I hope that clarifies the expectation on the balance sheet, pre-financing and post-financing. So then the second part is the profit and loss statements. So a profit and loss statement is what it sounds like, a statement that shows the profits or losses of a business. So let me just go to the first tab. And it does this by showing the revenues, or the money brought in by selling stuff to people, and the expenses, the costs of running the business, the costs of earning the revenue. So what we expect for this class, and what's fairly normal for a new venture, is that you'll have your first year's profit and loss statement broken down by month. So you can show, so this business, you can see they expect to bring in $2,000 in rental revenues in the first month, and they expect that to stay the same each month for the first 3, and then go up by, looks like 10%, and by another 10%, etc. So by the end of the, whoops, sorry, I'm clicking on the wrong window here. So we'll see the total. By the end of the first year, they expect to have brought in $27,600 in rental revenues. And then their sales revenue, you can see again, starts at 500, and they're projecting some type of increase in sales revenue. So they have 2 different types of revenues, one's for rental, one's for sales, and then you add those up and you get total revenues. And then we can see their cost of goods sold, which looks like they also kind of grow over time. It looks like they're actually a rough percentage of the sales revenue. Salaries and wages, which they project to be the same amount for the first 6 months, and then to jump up by 300 more in the next 6 months. Insurance looks like it's the same all year. Utilities look like they expect those to be the same. Maintenance costs, and then the interest expense looks like it varies a little bit. So people always ask, well, how do I come up with these numbers? Do I just make them up? And the answer is kind of. So yes, when we're in real life, what we're doing is trying to project them, right? We're trying to come up with an amount that we think is reasonable. And so we should do the same in this class. And that's going to just be based on some estimates or guesses. We don't know for sure, right? We can't tell how much business we're going to have in the first year, but we can come up with something reasonable. So in this sample, you'll see they have rental and sales revenues. So this example is kind of based on my old storage business. And so, how did I come up with rental revenues? I said, well, the business has 40 units that we can rent. Actually, it has more than 40. It has 50 units that we can rent, but we think we're only going to be 80% occupied in the beginning, based on talking to the previous owners and other owners that have similar businesses. So we took $50 per unit times 40 units, times 50 units, and then multiplied that by 80%. And that's how we came up with $2,000. Sales revenue is just based on, if we thought in a month we would sell an average of a $25 sale, and we thought that we could get 20 of those in a month. Again, that's just based on past experience or an estimated guess. And then you can see that as we kind of project our occupancy to grow, we expect our rental revenues to grow. So whatever business you're doing, just try to come up with some logical, reasonable basis for your estimated revenues. If I had a restaurant, I would just guess, okay, I think that a regular restaurant, maybe you could even talk to a restaurant owner or just Google it, but let's say a restaurant can, do 150 tickets a day. What's an average ticket at a restaurant? We'll say $30. And then we can multiply 30 times 150 to get a daily amount, and then multiply that by the number of days we're open in a month. And that gives us an estimate. We don't know for sure. We just want to come up with some reasonable guess, reasonable basis. Cost of goods sold, the same thing. You can just Google it and say, what's the approximate cost of goods sold for a restaurant? What's the approximate cost of goods sold for whatever type of business you're doing? Usually it will give you a number that's a percentage of sales revenues. And then you can just multiply that percentage times your projected sales revenue and come up with it. Salaries and wages, I would base that on the number of people I thought I had working on a given day, times their wage, times their hours, That would give me a daily amount, and then multiply that by the number of days in a month I have people working. Insurance, I could probably just Google and say, well, how much does a, how much insurance does a business expect to pay per month? Utilities, same thing. So yes, it is, you are making these numbers up, but no, you're not just pulling them out of thin air. Instead, they're educated guesses. And later in the course, you're going to do a page for your business plan called Assumptions that's going to explain exactly how you estimated these numbers. So you can't pull it out of thin air. You have to be able to explain it. And then, so that's our first year's profit and loss. And then we also do projected profit and loss for years 2 and 3. But those we don't have to break out as far down to a month. Instead, we estimate a quarter. A quarter is a 3-month period, right? January through March, April through June, July through September, and then October through December is how they break down years into quarters. But it's the same principle in essence. We come up with an educated estimate for a daily amount and multiply that by the number of days we think the business will be open in that quarter, and that will give us an estimate for revenue. Do the same for our costs. So again, it doesn't have to be perfect. I don't have any way of knowing. You're projecting. So if you come up with a number, the worst I could do is say, like, that number seems like it might be low. Where did you get it? But not really any more than that, because you're the one coming up with the numbers for your business. And since it's your business, something you chose, you probably have a better guesstimate than I do about a lot of the things. So I hope that helps explain what this assignment is all about. And if you have any other questions, don't be afraid to ask. And I hope you have an excellent day.